Welcome to the Balance Sheet, where you rise above the noise and learn about the most important business issues of our age. I'm your host and fellow student, Conrad Chua. Joining us today is a CJBS MBA alum, Gabriel Ronacher. He is founder of Argo Capital and CEO of Asia. Welcome, Gabriel.
Hi, Conrad. Thank you very much. It's a pleasure to be here, and I'm glad to be joining your podcast that I heard a lot several times before.
Okay, so if people have any questions for Gabriel later on, please put them in the Q&A box. But first, Gabriel, you founded Arco Capital as a search fund. In simple words or terms, can you explain what is a search fund?
Good. So a search fund, you can look at it from different lenses, but basically it is a private investment fund used by entrepreneurs and investors to acquire and take operating control of a small business. So for me, during the MBA, it was a potential career path, and the one that I took and I'm living on. I like to think of it as an overlap between entrepreneurship and private equity.
How is a search fund different than from venture capital or a pure play private equity fund?
Yeah, the main difference is that generally on private equity, you are acquiring the company, but you're not necessarily acquiring the full control of the company. And the person who is acquiring and making the deal is not the person that's going to be in the company. When you look on PE companies, PE funds, they usually acquire and hire some CEO and put them in the CEO seat to run the company according to an investment thesis that was drafted by someone on the M&A or a strategy team. Search fund is something that an entrepreneur, he has an idea of, he has a drive to run a company, and he gather a group of investors that really believe on his drive and on his sense that is going to be able to acquire a company. And the same entrepreneur, after searching and screening for a good business to acquire, he buys the company, and then he sits and takes on the CEO role, where he stays there and help the company get some growth and take the company to the next level.
Yeah. Who would typically invest in such funds?
The investor community in the search fund, and we call it a community because most of them are the investors, the group, almost most of them grows organically, are usually family offices, former searchers, former investors that learn about this model and really enjoy the way the model is set up in terms of incentives and also on the ability to work closely with a very focused entrepreneur, smart, who has just graduated from a good MBA school and is looking to acquire and run a company. So that is not only, when we're talking about investors are not only the source of capital, but they're also the source of mentorship that will help this young, driven entrepreneur to grow the company and pursue the investment thesis that was drafted during the acquisition.
So your investors, they were basically investing in you, right? Because at the time, at the beginning, there was no company to invest in. They have to put the money and faith in you. Is that right?
That's 100% correct. The search fund model, it's at least the traditional search fund model. It looks for not a specific sector in terms of company, and it doesn't even know what size or kind of company is going to be acquired. What the investors know is what the searcher promises to acquire in terms of business model. So generally, what we're looking for is a business model that's very resilient. And in that sense, it means that we usually want a model that's very CapEx light. It has a lot of recurring revenue. It has good margin. It has been growing profitably in the last years. And I would say a stable, resilient company that will, and we joke a little bit about it, that will survive the inexperienced CEO on the seat in the beginning. But also this very resilient business model will also allow the CEO to implement new things in the company and help it grow to another stage.
So your investors obviously saw something in you that they put money uh, in your good hands to acquire a company and run it. What did they see in you?
It's a great question. I think personally, I'm someone who is very driven. Whenever I saw the search fund model for the first time, I think it really fits my desire, not only as a job, but as a career, something that I would see myself doing 3 years, 5 years, 10 years from the time that I saw it and got to know the model. And it made sense on the stage of my career that I was to take on this entrepreneur role for the first time in my life. And I think I believe that talking to investors, they not only saw me as a professional with a good background, someone that was fit for the job, but also someone that was really engaged in the model and really on the committed to the model for the long term. But also someone that is friendly and nice to talk to, someone that's really coachable, and that's really important for investors because, I mean, in the end of the day, it was my first time being a CEO, and of course, we don't have all the tools, and we don't know a lot of things whenever taking this role for the first time.
Yeah. So you decided to set up your search fund, Arco Capital, in Brazil. What were some challenges that you faced, whether it was getting the search fund model going, but also within Brazil itself? Are there a lot of search funds?
The search fund model started in the US back in the 80s. And it has spread through Europe in the 90s. The first search fund in Europe was actually led by Simon Webster. And it has been growing very, very steadily since. When I first learned about search fund, it was 2018 when I had just joined the MBA. And I remember whenever, learning about it, my first question was, does this work in Brazil, which is not like the US, it's not Europe, is an emerging market with all the characteristics for an emerging market. And I went out to look for, has someone made it in Brazil at the time? And yes, I mean, at the time we had probably around 10 search funds in Brazil and probably 30 search funds in Latin America. And it made sense for me. I got that question out of my checklist of things to look for. Okay, the search fund model works in Brazil, so it makes sense for me to do that in Brazil because it's my homeland. Also, have network here, have family here, and I also understand the culture of the place. And that's something that's really it's not set in stone in the search fund world, but usually someone doing a search fund is going to do the search fund in their homeland, in their country of origin, because the M&A process itself, it's not only about the numbers, crunching the numbers and financial models, but it's also a lot of connection with people and being relatable to people. Also because of the type of companies that we are acquiring, which is a company that sometimes doesn't have, is a good company, it's growing, but sometimes doesn't have a succession or doesn't have someone to take on this role of leading the company.
So you checked that there were such funds in Brazil. Then I guess the next step was, did you have to set up a legal vehicle or entity for the search fund? And if so, what was is it the same as setting up a venture capital fund in a sense?
Yes, it has a lot of similarities as a VC company in the beginning. But I would say that before, start setting up, it was really about, understanding the model, talking a lot to searchers, not only from Brazil, Latam, but also Europe and the US, and talking a lot to investors to understand what was the investor appetite to invest in an emerging market for search fund, and how they saw the emerging Brazil as a potential investment place, but also what they saw in my background, which had nothing to do previous to the MBA with M&A. I was working in the oil and gas industry as an operations manager. So it's quite different, the deal, but also has a lot of similarities with running the business after it has been acquired. The VC funding in the beginning, especially on what we call the search phase, which is the stage where you have raised what we call the search capital with investors, and then you're screening and looking for a good business to buy. And on the time that you do the acquisition, then you do another equity fundraise with your investors, and then you set up a different legal entities according to your investor base at the moment of acquisition.
Oh, okay. So once you got all that initial funding, and you were looking, I think you told me you screened almost 1,500 companies. How did you go from 1,500 to one target?
Yes. So the moment that as I was saying, the moment that you raise the search capital, you're basically, as a searcher, you have from 2 to 3 years of funding to find a good business to acquire. So in a sense, the clock ticking, and you need to be organized and set up almost a funnel, a pipeline of deals to be able to find one good business. And you don't need to find 10, you just need to find one and acquire one business only. And there's basically 2 ways of looking and finding a business. One of them is working through business brokers, M&A advisors. And the second one is what we call proprietary deals. So business advisors, they have companies on their hands that they are advising, and the companies that are, in a sense, are ready to be sold. And as you understand and study the company, and then you get into a discussion with that. But on the proprietary search side, you're actually looking for a company that's not necessarily on sale. So you're basically knocking on doors and talking to business owners and say, hey, I'm Gabriel. I have funded Arco Capital and I'm looking for a great business to buy. I got really interested on your business based on what I've learned from it, from other people or internet or however you got into that business. I'd love to talk if you would be willing to, potentially sell the company to that. So on the proprietary search, I really have built a pipeline with a lot of companies going through it, where we did a basis, and until the screening got us to meetings with the owners, and the meetings got us to understand their financials, and then eventually to put on bids for this company in place, offers for this company in place. And 1,500 companies is a lot of companies, yes, but it's really common in the search fund world during the search phase for people to look for thousands of companies, especially in the US. It's really usual to look for tens of thousands of companies until you find only one good business.
So what did you see in Azure?
Yeah, Azure, it checks all the boxes for what we look for in a search fund business. So Azure is a software business on the insurance distribution space. We are a SaaS for insurance brokers, which are our main customers. And Azure was, at the time, and the acquisition was made in 2021, it was growing plus 20% a year. It was very cash flow positive. It had a lot of 100% of recurring revenue. It had no customer concentration. Being a SaaS company, it also meant it is scalable. And within the market that Azure X, I also saw a lot of opportunity of further growth without any major competitor being able to have a lot of bargaining power or pricing power against us. So I believe Archer is a very traditional company that checks all the boxes in what you call the recipe for a search fund acquired company.
Good. So if Azure was doing so well, um, what was it that you offered to them, that got them not to slam the door on you, and start talking and getting a deal?
That's a fantastic question because that's the thing about search funds. Azure was a great company. It was doing great already in the time, and the founder of the company, who was running the company, had been approached already by other funds or strategic players in the market. And for some reason, maybe it's, of course, the offer was not big enough in terms of the check size. But one of the things that for sure was also into play was what's going to happen to the company after I sell the company. And the search fund model, and generally, but also it was one of the things that I brought into the table. It was, we're not getting your company anywhere. You're going to be passing on your legacy to someone that is going to respect it and keep the company growing with the people that are within the company. Of course, we bring new people to the company, but there's a lot of the founder seeing in you, the searcher, as his succession, also. And that was the case in Niger, in a sense. Of course, not 100% of it, but it's a very, I would say it's kind of a competitive advantage for a search fund to acquire companies, is because it's a very personal connection that you create with the founder. And I'm not just, some guy from an M&A department or a M&A fund that's going to acquire the company, and the company is going only to, you don't even know, the founder doesn't even know who is going to run the company after it's sold.
So two great points there. I think one is that, obviously you have to do your due diligence and the financial spreadsheets and modeling, but ultimately it's that personal connection and that empathy with the founder, right? And who's going to sell the business that really helps. And I find, sometimes speaking to MBA students, that they focus so much on the analytical side, right? But it's not about who gets the best spreadsheet, but it's more about that connection, right? That seals the deal. But I thought it was really interesting what you mentioned, that the founder was the CEO, and the founder sold the company to you. Did the founder make it easy for you, or help you in that transition to take over as CEO in a way?
Yes, he did. And that's great. I mean, of course, it's not always the rule of preserving a great relationship with the founder. It can happen in many different ways, but the founder of the company is a great guy. I still have coffee with him sometimes. He goes there, he visits the company. In the beginning, I mean, during the transition phase, it's a hard time for everyone, not only for the CEO who has just sat on that seat, and especially me. I am an engineer who was working on oil and gas, and then I'm sitting on the chair of a CEO in a software company in the insurance sector. So two different worlds coming together. But it's also a very hard time for the employees of the company, because they don't know, they didn't know who I was. It's a lot of anxiety in the company, and it's very important that the founder uses that transition phase to give confidence to the employees and to help them trust me as the new manager of the company. The founder is always a very important piece of the whole puzzle, not only during the negotiation phase in the deal part, but also right after it, making the transition as smooth as it can be.
So, for the people listening, if there are any questions, just pop in the Q&A box. But so Gabriel, you said you're this is your first time being a CEO, and this is a completely new industry. You've been searching all this time, and then now you got the CEO seat. How did you? What were some of the leadership challenges or lessons that you had to learn very quickly?
And so if you think about the whole search fund cycle, you fundraise and then you search for a good business to buy, you acquire the company and then you run the company for a longer time. There's a lot of tools that you need to use in this very diverse cycle in terms of skills needed. And I had to recur a lot of times to the toolbox that the MBA gave me. Especially during the transition, I remember a lot getting back to the articles from the management practice classes, talking about that saying from the class, my word is not your word. And this is maybe the mantra of my MBA at the time when I was in Judge, and it was exactly what was happening when I just took on the seat at Azure. Because Gabriel, myself, was some guy, when an MBA in the UK, coming back to Brazil, but I was sitting in the seat of a company that is not in a major city in Brazil. It's 200 kilometers away from São Paulo. Most of the people in the company had only worked at that same company for their whole career. So it was two different worlds coming together, and I really had to use all the tools that I had been taught during the MBA. And this is just one sense, right? I'm talking about management practice here, but when you look on a different part of the cycle, on the deal making, there was a lot of the tools from also the lectures that I attended during my time at Judge as an MBA alum.
I'd like to ask a few more questions about the leadership side, but we have a question from the audience, which was, how did you go about finding investors when you were doing the fundraise?
So there's, as I said, there's like a community of investors. People get to know each other, and before you really start fundraising, it's really important that you get to know who invests in this field. There are tons of investors currently, and you really need to talk to the investors, present yourself, even if you're not fundraising yet, but tell them your story and say, I really want to do a search fund for this and that reason, and understand if there is a fit. It's not only about the investors giving you money, because that's not what search fund is about. It's the investor shall see in you someone that he will help pursue a career path, that he'll be able to coach, and then he'll give you the money. So you really need, is not only about knocking on people's doors and asking for money, but creating relationships and connections with those investors. And that start as simple as sending out some emails, asking for a warm introduction, presenting yourself, and walk the road that needs to be walked on.
Yeah. And I think a follow-up question is, you mentioned when you set up Arco, you were getting investors first, and I guess they were putting enough money to last you for 2 years while you searched for an acquisition. I think the question was, is that always the case, or is there a push where you've already found some target companies and then you do the fundraise? Do search funds operate in that way?
Yeah, search funds are what we call the traditional search fund. It operates in a very very strict way, in a sense. So you're going to raise the search capital, you're going to go through the search phase, and then you're going to acquire the company with the terms already being well known within the investor community and the search fund community. But if you look on a broader aspect, if you zoom out from the traditional search fund, there's a lot of different ways of doing what we call the broader entrepreneurship through acquisition, which is basically you being an entrepreneur, but you're acquiring a company to become an entrepreneur. So the traditional search fund kinds of sits in the middle seat there, But on one side, you have what's called the self-funded search, which is you're looking for a company without any investor capital. And then when you find a company, then you look for investors to help you acquire this company. And then on the other side, you have also a different model, which is the kind of search fund accelerators, which are groups of people or funds that sponsor an entrepreneur, but it's going to be most of the time only sponsored by this search fund accelerator, and to help the entrepreneur look for this company. So there's a lot of different ways that the entrepreneurship through acquisition can be achieved or taken on. But the traditional search fund is just the traditional way of doing so.
Well, you mentioned a few times how you like your investors, and your investors actually like mentoring you, right, and developing you as a leader, as a CEO. So, do you meet up with your investors every month? And sure, obviously, you have to keep them updated about what's happening with Azure itself. But how do you have those conversations with your investors where you're asking them to help you develop as a leader, as a CEO?
That's perfect. Yeah. It's a process. It's an evolving process over time. I've been on that road for 5 years now. And in the beginning, during the search phase, you are much more closely in touch with your investors, because it's the search phase. You're not only looking for a company, but it's also a time where you're getting to know better your investors. So during the search phase, I had a lot of monthly or bi-monthly meetings with some investors that wanted to be closer to me, and that helped me create, not only be coached by them, but also create the relationship with them. But after you acquire the company, then the dynamics change a little bit. So you acquire the company, you set up a board of directors, which are appointed by the investors. And then most of the time, the CEO is dealing with the board. The CEO is also a member of the board, but is also dealing with the board. And then I started, in my case, we started having monthly meetings right after the acquisition, and then quarterly meetings, which we still have up to this day. And the remaining cap table, the other investors that are not board members, we usually update them quarterly also. And eventually I have calls with some of them that have specific actions, questions, or maybe they have some specific knowledge on the sector and then I want to take on their advice. So it's the process that goes through an evolution over time, as you also learn a little bit more how to be a searcher, how to be a CEO, and as your investors also create a relationship of trust with you.
Gabriel, we were talking before we went live about the sort of different incentives, right? And this is something we study a lot on the MBA. I'm just thinking, if it was a PE company, for example, and they parachute in a new CEO, obviously they would try to align the CEO's remuneration package with the company. But is there a different sort of incentives at play for you as a CEO of the search fund that you've created, because you've acquired that company, right? Are those incentives different? Where between a CEO that's been parachuted in by a PE firm versus you as the acquirer and the owner of a search fund?
Yeah, I would say the incentives are set up in a way in between the PE and the VC world, which means after I acquired the company, or the searcher acquires the company, the searcher receives a equity, a part in equity of the company. But then he has other tranches that are vested over time. One of them is vested based on time, and the last third, the last part of the tranche is vested based on the return that you're giving your investors. So I really like how the way the traditional search fund model was set up, because the incentives are very, aligned for you to be not only a CEO that was got out of the market and put on that seat, but from the beginning you have a stake in the company, and you have to think not only as a CEO but as the owner of the company. As the time goes through, and the time invested stocks that are granted to you, then you have a bigger stake in the company. And then if you give your investor a greater return, then you have a bigger stake in the company. So it's also a kind of an evolutionary progression of your stake, the company, that makes you really have the same incentives as the investor whenever taking a strategic decision of how to grow the company or the next steps for the company.
In terms of like exits, for example, typically, how long is a search fund's sort of investment horizon?
Typically, after the company is acquired, so one step before. So typically, you search for a company for 2 to 3 years, and then you acquire a company. After the company is acquired, you typically stay in the company for 5 to 7 years. The thing about the search fund investors is that you don't have a mandate to sell the company in a specific time frame. So if the company is doing well, you can always, stay in the company for a longer time. And we have search fund acquired companies, especially in the US, will have the same investors that they had when they were acquired 30 years from now. Of course, it depends on your cap table. I mean, the investors that are with you in the business, but also depends on the opportunities of the company, how you're liking your experience as CEO, how long you want to be there. So there's a lot of things at play that could drive the decision of an exit in 5 years or later on. But most of the time, I think what's important to talk about is that you have this 5-year typical time frame, but it's not fixed or it's not written in stone. You actually have kind of a flexibility that depends on your investors in the end of the day, and your relationship, and how you're on the company, how you're feeling about running the company for more time.
You've obviously acquired Asia, and I know there's been some other bolt-on acquisitions that you've done since then. So can you talk a bit about what are some of these M&A dynamics like in Brazil or in Latin?
Yes, sure. So the M&A part, the M&A sector or M&A industry, should say, has a lot of difference when we are comparing to developed countries. I would say on a macro level, we're talking about an underdeveloped economy, which means that has less diverse companies and therefore less M&A targets to be acquired, or less M&A acquirers as well. Also, is a more volatile economy, which can scare for a bit of foreign capital to fund those acquisitions. It usually has complex regulations and less access to economic data, industry data. We have less market research reports. So the information is in a way not so on the surface, and you need to dig in a little bit deeper. But also, outside from the macro level, also on the culture level, M&A is still perceived as a niche and something that's only sought for larger companies. It's not something that's seen fit for a small and medium business, like a potential target for a search fund. A lot of founders or owners have never thought about selling their business. They neither know how an M&A process looks like. And therefore, this lack of education on M&A terms and practices also makes it a little bit harder for M&A acquisitions to happen on emerging markets. But looking on the bright side, this is also an opportunity, because if you are being a searcher or a partner in a PE fund or an acquirer in any sense, is able to navigate this so complex environment, you actually get an edge and you probably have less competition to find a great business to be acquired. So, of course, there's no right and wrong. I think there are pros and cons, but definitely it's a different landscape to navigate.
Gabriel, before the MBA, you were in the oil and gas side, you were in the engineering aspects. Was that right? Yeah.
Yes.
And then you came to Cambridge.
That's correct.
You were doing the MBA. Do you remember when was the first time you heard about search funds?
Sure. A little bit of background was that when I finished my school and became an engineer, I always wanted to be an entrepreneur, but I really never found a way of becoming an entrepreneur. Like I didn't like startups. I never saw myself running a startup, and neither had I a family business to run. So I engaged very early on in my career in a very traditional engineer path. And one of the reasons that I decided to pursue an MBA was to, after the MBA, maybe join a smaller company and then spin out to something that I could be the entrepreneur. And I clearly remember the first couple of months in the MBA, there was a session about entrepreneurship through acquisition and search funds. And it was a panel with the people in the different phases of the search fund cycle. And on the session was about 30 different MBA students. And when Simon was talking about the model, it was a eureka moment for me. Like, it made so much sense for me, and probably it was one of the first time that I thought, that is exactly the career path that I have been looking for in my school, 10 years ago. And I was looking around, and everyone was just hearing about search funds, and I was like, I couldn't hold myself within. And after the session, I spoke a lot with Simon and with the panelists, and decided that was what I was going to pursue after the MBA. Then I already shifted, my MBA to something more towards, search funds. And I took on a summer internship in a PE fund in London to get a little bit of experience in the deal-making part of the process, which was my background that had a gap. A very strong gap, right? I mean, coming from operations, and then, well, that's it. That's history now.
So we'll have people who are listening who are either current students or going to start an MBA. What advice would you give to anyone who's considering going into the search fund sector after their MBA?
I would say first to do a lot of research and talk to as many people as you're able to. It's not the search fund is not a job. It's a career path. It's something that you need to be engaged and committed to for maybe 7, 10, 15 or more years. So it's not something that you can really, I started searching for a company, but I don't like it. I'm going to quit and leave all your investors behind. So there's this consideration, and it demands a lot of reflection if that's really what you like. But also talk to searchers who are on the search phase, who have acquired the company, who have failed at acquiring the company, who have failed on raising capital. Talk to investors who like search fund model, and investors who potentially don't like the search fund model. I think the more you study and reflect upon if the search fund, it will make you more prepared to make the decision. The people from the community is very open to taking on calls, to explaining the models. So it's really easy to get this kind of help and this kind of call with such people.
And final question is, what's next for you, for Arco, for Azure?
Well, Azure is doing great since we've acquired. The company has grown from 40 people to 150 people now, employees. We have offices not only in Rio Claro, which is the headquarters, but also in the south of Brazil and now in São Paulo. And there's just a lot of opportunities. The company is growing well. Investors are happy, hopefully. I think they are. And Azure has a lot of room to grow yet. I think we're on a great market. We are being able to really make an impact in the insurance distribution space in Brazil, which is really, really exciting.
Oh, well, thank you so much, Gabriel, for giving us this wonderful introduction to search funds, to your own career, to leadership, right? As well as M&A in emerging markets. So thank you so much. Thank you to the audience as well for staying. And, I think people can feel free to reach out to Gabriel if they are interested in any of these topics, right? So thank you so much to everyone. And till then, please stay safe and we'll see you next time.